welcome to today's Big Data AI Hub seminar. My name is Irene Wysek, and I am a professor of accounting and director of the Big Data AI Hub here at our Institute for Management and Innovation at the University of Toronto. Our goal at the IMI Big Data AI Hub is to engage interested stakeholders in discussions around the increasing use of big data, AI, and other emerging technologies. So we're excited to have you here with us today. Special thanks to Professor Michael Morrison for lining up our wonderful speakers that we have here with us today. And we are going to be talking about ESG reporting. That's to do with environmental, social, and governance. And entities are increasingly reporting on environmental and social factors, in part because capital providers such as investors and creditors and other stakeholders are demanding it. In addition, reporting standards are becoming more aligned and enforced globally. Much of these disclosures are non-financial in nature, for instance, information about greenhouse gas emissions. So how does an organization collect and distill this data so that insights can be reported to enhance and support decision-making? Not surprisingly, big data, AI, and emerging technologies play a big part. Before we start, just a small note that this session is being taped, and we will put it up on our website afterwards, as we do with almost all of our sessions where we can tape, so you can look at them after. Feel free to share them. If you have any questions today, please feel free to put them in the chat, and we'll do our best to get to them throughout, and we'll save time at the end for your questions. And now I'm very pleased to introduce today's presenters, Scott Morrison, who's a partner at PwC in the ESG and sustainability practice, and Renee Alessio, also with PwC, who's a director there. So please join me in welcoming Scott and Renee. I'll turn it over to you, Scott.
Turn myself off mute. There you go. So thank you very much for having me. It's definitely a privilege to come here and speak a little bit about what we're really seeing go on in terms of the ESG marketplace, some of the trends that we're seeing, what investors are asking for, what regulations coming into play, is also kind of the evolution of the reporting landscape as well too. And I would say there's certainly a big importance and piece to play around IT and data, and my colleague Renee here is going to speak a little bit about that, because I would say what we're seeing is really a lot of companies focusing on gathering that data, collecting it, analyzing it, and really using it to their benefit as they kind of prepare for all the requirements coming down the road. So if we can kind of go to the next couple of slides, so just kind of going into this first section. And definitely encourage any questions that come across. We're going to make sure that we pause throughout the presentation to answer any questions for the audience member. But if we kind of jump right into ESG trends and development. So going in the first phase, I always like to kind of start my conversation around ESG. What's really driving this, and what are we seeing kind of happen in the marketplace? And there's a number of key stakeholders, and we've listed a few of them here on the slide that really show that they're increasingly focused on ESG and increasingly focused on companies' performance and how they're managing these risks and opportunities. So I wanted to share a little bit about a few of these kind of key stakeholders. And maybe the first one, as I was mentioning kind of in my intro, being investors. And I'll lump in capital markets and lenders in there. And those are organizations like you see banks, pension funds, asset managers, as well as even insurers. And I think one thing that we've really seen is those investor communities being a lot more active. There's been a big focus and shift towards, maybe several years ago it was a focus on, an oil and gas company and their carbon footprint, or, a company that is, producing things, and, what's the impact down in their supply chain? Is there modern slavery? Also recognizing, and this has really developed in the last few years, is that capital providers are ultimately providing capital to various companies in terms of driving environmental benefit or social benefit. So there's been a big focus on that. And again, to bring that to life, I give an example of what we're seeing. A lot of asset managers, pensions, and even the banks started to calculate and really assess is their portfolio carbon footprint. So what's the carbon footprint associated with the capital that they're deploying to various companies and these economic activities as well? The other big thing I would say that's worth highlighting that we've really seen develop with these investors in capital markets and their focus around ESG is the level of sophistication. And again, to bring that to life, I would say several years ago, they would ask a company, do you have a net zero 2050 commitment? And it would be a box check, a pat on the back. Well, fast forward to today, there's a lot more sophistication coming from their questions. So, what is your interim targets? What does this mean for your business model? And what does this mean for your cash flows ultimately? So I think we're seeing a lot of increased attention there. And just to highlight another example, I was actually at lunch yesterday with the CFO or CRO of a company. And they sent me an email after the lunch, and it was that exact thing, an email that came across from one of their investors, really highlighting some of those key questions and really looking to look under the hood and understanding how they're approaching climate and what's their plans going forward and what it means for their business. So I think fast forwarding, we're going to continue to see that from those investor communities. The other thing just to share a little bit about is customers. And, that's an important one because there's that direct link to revenue. So I think what we starting to see is companies focus on their customers as key stakeholders, and we're seeing an increase focus from customers looking through their supply chain and having various expectations from organizations that they're doing business with. So certainly an important one to address because there is that direct link to revenues and important to understand what your customers are expecting, important to attract it and retain that customer base as well. The third one, maybe I'll just speak to on this, and a big one for human capital driven businesses, and I could say all businesses as well too, is employees. There's various studies out there globally that really show that employees want to work for companies that perform well in ESG, that have an ESG strategy. So again, I would really say that amplifies in companies that are really driven by human capital, and it's important to attract and retain your talent. So again, another key stakeholder to look for and something driving various companies' ESG strategy and ultimately what they're reporting. If we can go to the next slide. So this paints a little bit of a picture, shows ESG, it is very broad. There's a lot of topics under the E, a lot of things under the S, and as well as the G. A lot of times, when we pull this slide up, it questions, well, should we be focusing on all these areas? And the answer to that is no. Well, one, this probably, doesn't make sense. A lot of these might not be relevant to your business or might not be material. And that part about material is critically important because it really amplifies the importance of materiality assessment. And what we're really seeing companies do is get a lot more sophisticated around that, is looking at their key stakeholders, what is their key focus areas, what's driving their decisions, and then ultimately crafting and focusing your ESG strategy and reporting around that. And, as an example of like when companies don't do their materiality assessment correctly, we can quickly see them falling in the trap of trying to focus on too many of these topics, ones that might not be relevant or material to their business. And then you fall into the problem of, well, of all our focus of time and effort, is it going to dilute our return on investment for these various initiatives or focus areas? And then even on the reporting side, so what you might be reporting for ESG, you could fall into that trap of quantity over quality, and then quickly amplifies, the risk of greenwashing as well too. In terms of materiality, I'll kind of also just quickly comment that there's two ways of looking at this. And I would say, the trend that we're seeing in the North American markets is taking a very financial kind of materiality linkage to, these ESG topics versus when we look over to our European counterparts, for example, is they're taking very much of a double materiality. So that inside out and outside in kind of view, and what is the impact that your company is also having on society or the environment. So a little bit of a different approach there. We can go to the next slide, please. Perfect. So this shows a little bit about, going back to that financial piece, is a little bit about how companies can start to, look at these various things that they're doing and linking it back to cash flows and ultimately the impact that the ESG or the ESG initiatives that they're doing is having on their valuation and their enterprise value. So now I'm not going to go through every one on the slide, but just wanted to bring it to life a little bit and maybe go through a couple examples. So on the revenue side, for example, there's a number of real estate organizations, and I look more to, say, commercial real estate organizations, for example. They have a lot of large institutional marquee tenants, like companies like Walmart's or Canadian Tires, or the large grocery chains. And I can say for certain that a lot of those large institutional organizations, they have their own ESG strategies, goals, or regulatory requirements, for example. So the real estate industry is a really good example of, they're really focusing on ESG and the energy efficiency of their buildings, for example, or the climate resilience of their buildings, because they see it as something critical of attracting and retaining some of these large institutional marquee tenants. So again, there's that linkage to, well, are we doing A, B, and C? Are we able to now, attract our buildings more to some of the tenants that we want, and again, desire more rent as well, too. So that's one example. The other example I would give is on the expense side, and I'll highlight borrowing costs. And a lot of companies are raising capital, to support their business, support their operations. And what we're starting to see is the sustainable finance avenues really pop up in the marketplace. So things like some have heard of, green bonds, green loans, or sustainability linked loans as well too. And the great things about these is you're actually able to, achieve a slightly lower borrowing cost in some situations. So again, an opportunity to leverage off some of your ESG initiatives, your strategy, and the work that you're doing, and embedding that into kind of your capital raising, and again, lowering that borrowing cost, which ultimately is a positive for cash flow. So wanted to kind of share those two examples because we are starting to see companies get a little bit more proactive in really using kind of discounted cash flows as a key tool to prioritize, some of the impact of these various initiatives. So the next slide is more just kind of a plug. So about a few weeks ago, we released globally our PwC Global Investor Survey. And what we did is part of this, we actually interviewed and surveyed, hundreds and hundreds of investors around the world, institutional, retail, asset managers. And, similar to prior years, ESG was a key theme and insight that we came out of that global investor survey. What we've included here on the slide is a few pieces or insights that we found is part of that study. The first one is, 3/4 are using are looking, how companies are managing sustainability, risk and opportunities, and it's being important to their investment decision making. But the second one in particular is what I'll really highlight is 94% of investors believe that corporate reporting on sustainability reporting or sustainability performance contains at least some unsupported claims. So what that means is there is still that kind of perception of greenwashing in terms of a lot of organizations telling the good story and not the full story, or kind of exaggerating a little bit on some of their ESG reporting. So that actually closely links to that third finding we have on there, which is, again, a trend that we're going to continue to see is increased calls and expectations for assurance over this sustainability information. So 85% have said that they want to see reasonable assurance, which is the same as having like an audit of a financial statement over that sustainability information, and that's really going to build the trust and confidence in the information that's being reported. And Renee is going to talk a little bit about this later on, but there's a big piece that is getting comfortable with your data, the quality of the data, integrating it together that has a big piece to play in all of that. So if we go to this next slide, I just want to highlight that, yes, investors are caring about it, customers are caring about it, but I didn't talk about regulation quite yet because there is a lot of regulation that's emerging. And the next slide, I'll talk a little bit more in detail about that. But just to highlight maybe a couple points is we're seeing regulation emerge from two areas. One from the securities. So, from corporate listed organizations, so companies that trade publicly. There's also some that's impacting private companies, but there's also regulation that's emerging that's impacting underlying assets. So we're seeing, again, regulation impacting like specific buildings, so at the asset level, or specific products like, the use of plastics that go into it. I'm going to spend a little bit more time, I would say, talking about the corporate level. And if I just highlight kind of that quote on the left side, because it's actually a really good quote, and it's from our CEO of the Ontario Securities Commissions, and he sent a letter out to the Institute of Corporate Directors I would say a couple weeks ago, so fairly recent, and talking about the climate regulation that's coming into play here in Canada. And what he really says is that we're not making this regulation we're not making a lot of this determination, but from a regulatory perspective, it's really investors themselves that are asking for this. So again, linking back to the point about the regulators are playing a big role to protect the users of this information, and a key users is certainly that investor community that we're seeing. We can go to the next slide. So this gives a little bit of a snapshot about the regulatory environment. There's a lot emerging globally. I feel like it's almost changing, every few weeks or every month. So there's a lot of things going on. But what I thought might be a little bit helpful is give a little bit of background of state of play and what's kind of impacting Canadian companies as well too, and as well some of the global companies that we're seeing around the world. And the CSA, so that's the regulatory body that kind of that the OSC, Ontario Securities Commission, kind of rolls up to, and that impacts what Canadian listed organizations are going to need to do for ESG and climate. So they were actually one of the first ones globally to come out with a climate regulation, and it was back in October 2021. So almost 2 years, or just over 2 years ago now. Looking, it's already November, or sorry, it's almost December even. But so one thing to highlight there is, compared to what subsequently came out, like from the SEC, Europe, and others, it didn't have that much teeth. And as examples, there was statements like you can comply or explain. So if you don't want to comply, you can just explain why you don't need to, or there wasn't assurance requirements. So they actually kind of made a statement, we're going to take our foot off the gas and really assess what's is going to develop globally. And I think why we don't have an update from them quite yet, we highly anticipate them to align with the ISSB, which I'll talk about shortly, which is your International Sustainability Standards Board, and some of those new IFRS sustainability standards, which we've highlighted on that red line below. So more to come from what's going to be required from Canadian companies, but I think really what people are starting to see is that it's likely to align there with the ISSB. The other big one is SEC. So they came out with a climate proposal. I think it was something like 400 or 500 pages. So it was quite comprehensive. Different political environment there. They had something like 14,000 responses back from various organizations. But things like assurance were required, climate scenario analysis, scope 1, scope 2, and scope 3 greenhouse gas emissions. And we are still waiting for the SEC to give an update, and hopefully over the next few months we'll have an update from the SEC, which they're going to require companies to do. And maybe just the last one, just to highlight, because is European. If you can just go back to the previous slide there, yeah, it's just the middle one, CSRD. So that's the European regulation. Two things to highlight there is they're casting the net on the private sector. So it's not just publicly listed organizations that trade debt or trade equities. It's the private sector as well too. So, and the threshold is quite low. So that's quite unique from what we've seen globally. And it's actually impacting large Canadian companies. So as an example, you have a large Canadian organization over here that has EU operations. Well, now because they meet some of this threshold, they fall into scope for some of the EU regulation. And the second point I want to highlight on that EU regulation, it's probably the most onerous and burdensome in terms of regulation we've seen around the world. So quite vast, quite broad, and again, a lot of requirements that the companies need to work through. If we can go to the next slide, please. So I mentioned on that the CSA, so the Canadian regulation, like they're likely to align with the ISSB. We're actually seeing others globally, like the UK, Australia, Brazil. They've kind of put their stake in the ground saying we're going to align with the ISSB. So I wanted to talk a little bit about that, and in terms of what we've started to see with the ISSB. So the ISSB is your International Sustainability Standards Board, and they were set up really to solve that problem of an alphabet soup of different ESG standards and frameworks out there. And I always say it was like comparing, well, it still is to some extent, comparing like apples to pizzas. So not even in the same food group. So it was a very welcome change to, again, create that global baseline and create more consistency and comparability within the sustainability space. And why is this important to Canadian companies? Well, one, the regulation, which I already talked a little bit about. Two is the investors and support from organizations like that. So we actually had our Canadian Maple 11 pension funds, so our biggest pension funds in Canada. the CEOs of that signed a joint letter, signed saying we highly endorse the ISSB. And if you want our capital, we expect you and recommend you to align with ISSB going forward. So a strong message there from the capital markets. And then the third point is the Canadian Sustainability Standards Board has been set up, and that's our Canadian kind of endorsement and review process that takes place to really put that Canadian wrapper on and make sure that the ISSB standards are fit for purpose for Canada, very similar to what we have for the Canadian Auditing Standards Board, doing review of IFRS standards, updates, and items like that. So if we can go to the next slide. So the next slide, this is more of just kind of, I would say, a little bit of a takeaway. We actually just launched yesterday our ESG reporting insights report that we do. This is the third year that we've done it now, and we reviewed the top 250 companies here in Canada through a set of 50+ questions, and really to give us some insights like where is the Canadian marketplace as it relates to ESG reporting, who's doing what, who's not doing what, and kind of where does it take into consideration what's coming in terms of some of these standards like the ISSB. So there's a link there. I'm sure we'll share some of these slides afterwards as well too. And then take a look at it. There's some really good insights in terms of what we're seeing, who's disclosing scope 3, who's disclosing scope 1 and 2, and then again things like who's aligning with the TCFD and some of those pillars like strategy, risk management, governance. So a lot of really good insights there, I would say. And maybe just to kind of conclude, so I talked a little bit about the trends that we're seeing, why companies are focusing on this, but a big part about the reporting piece. And just to kind of tee up Renee, and I think there might be a couple questions which we can go through before then. But a big part of this and where things are heading, there's a huge importance for data, technology, and really integration of that, because it's going to be critical in making sure that not only companies can report externally and be able to be assured, for example, but also for management reporting. And what we're rapidly seeing is management are making decisions and allocating capital to certain things based on some of this data. So again, amplifying the importance of that, I would say, certainly. So I think we do have one question that has come into the chat. I just need to figure out how I can open the chat. So Samir, I'm wondering whether we can have PwC webinar on ESG. Okay, so that's just more of a takeaway question. So yes, please feel free to send me an email. I'll send you an email afterwards, and we can certainly have a chat and see how we can help out from that perspective. I guess before I pass it along, any other questions, feel free to come off mute or throw it in the chat. And if not, I can pass it to my colleague. All right. Oh, got one question. So how are companies preparing for ISSB S1? Do we see it as the holy grail of sustainability reporting? That's a great question, and I would say that one, we are seeing it as a lot more convergence and support around it, especially on the regulatory side of things. I'll push the EU aside for just a second, but going back to those points before, like I think everyone recognized the sustainability reporting space. Like it was a little bit of an alphabet soup, like in terms of different ESG standards, frameworks, and it's kind of confusing even for preparers to say, well, what standards should I be following? So the ISSB did a really good job of actually consolidating some of that, converging it. So things like the SASB, TCFD, the integrated reporting model. And I would say just over the last several months, we've seen a lot more support and endorsement behind it. So like I gave my example of UK, Australia, Brazil, I think New Zealand as well, and it's probably where we're going to end up in Canada. And from that regulatory perspective, I think it's really going to kind of be the holy grail, because one, it's really linked back to financial materiality, and that's what a lot of the investor community is considering is, well, what do these topics, these risks, these opportunities mean ultimately for your future prospects, your long-term sustainability as a business, and obviously the returns of the business going forward as well too. So I think they've done a really good job in that, and we're continuing to see a lot more support around it. So will it be the full holy grail? Like, no, but I think we're going to see a lot more convergence and support and reporting under that going forward. On the part about companies preparing for ISSB S1, so there's S1 and S2. There's a little bit of both, and we're working with several organizations right now in the Canadian marketplace and helping them get ready for that. So doing things like gap assessments. What have you currently reported? What is required from the ISSB, and where are those gaps and heavy lifts that you need to action and work through? So I would say, from my perspective, we're seeing companies in the Canadian marketplace move full steam ahead as it relates to that. And speaking to some of my colleagues in the UK and Australia and Brazil, the exact same thing is happening there. And I think right now is what a lot of organizations are working through, like what are some of those significant lift areas? And again, what data do we have? What data don't we have? What do we need to gather? What do we need to estimate? And then there's also the element of how can we make our reporting quicker? Because that's a key fundamental piece of the ISSB is aligning reporting with the same time as your financial statements, where a lot of the time right now, there's a little bit of a lag between the two. What business schools, so the next question is, what business schools should do when it comes to sustainability reporting teaching? So I actually think, like, and Irene knows this as well too, we've had several conversations. I actually think the universities have a huge role to play, because I think where this is going, it's a long journey ahead. And I always go back to the saying is, someone said the first journal entry was done 500 years ago in Italy, and we're still working through accounting changes. So with sustainability reporting, where this is going, we got a long way ahead to where this needs to go. And with that being said, we need talent and people that are very motivated, that want to go into this area and help support it. And I know one thing that we've tried to do with PwC is definitely tap into some of those resources and campuses, knowing that there's a long journey ahead that organizations need to work through to meet some of these sustainability reporting requirements, whether it's through investors or regulation. So with that being said, I do think the universities have a really good role, like they have for many other things, to play a role in educating students and getting them prepared for what are some of these very topical issues and challenges that companies are working through. So another question, do you think it makes sense for reporting companies to hire people skilled in advanced computing for reporting purposes? If so, how can they utilize this skill considering the current state of the reporting size and data? So Renee, this is probably going into a little bit of you, but I would say yes. Like from my extent, like I think there's a huge amount of value. Like I give an example of some of the financial institutions I work through. Like they're calculating their carbon footprint of their investment portfolios or their loan portfolios, or doing climate scenario analysis, which is heavily driven by data and heavily driven by creating formulas, or not formulas, creating automated solutions to help support the reporting on a much more quality driven basis, but a timely basis as well too. So my opinion on that is certainly yes. I don't know, Renee, if you have any comments on that.
I do, and I it actually tees up my next slide, unless there's more questions there you've got, Scott.
I think I just see someone agreeing with a comment, so it's good. So maybe that does tee up the next section quite well, and we can dive into some of the data impacts and tech impacts as well.
Yeah, thanks, Scott. So I'll maybe move to my next slide, and I don't know who the question came from, but exactly that. So Scott shared a little bit of information about the insights that we had gained from our global survey. And one of the stats he shared was that a great proportion of survey respondents felt that some of the disclosures that had been made were unsupported claims. And so what we know about ESG reporting is that it's about trust and transparency. And it's going to require a cross-functional team at any organization to solve this complicated challenge. And so do I think it would be beneficial for organizations to have individuals with advanced computing or engineering? I'm a scientist, Scott's a CPA, and so we are diverse teams. And so absolutely yes. It really starts with, and I'm going to jump into my presentation here, clear governance. And so making sure that organizations have good governance models with clear and roles and responsibilities is critically important when you're embarking on your journey. And we usually think about taking these first steps along this trustworthy and transparent reporting journey, focused on 5 main pillars. And so the first is beginning with a strategy. And Scott touched on it briefly at the beginning of his presentation, but I might reinforce a few key themes that will show up again when we dive deeper into the data and reporting piece. And so when you're starting with your ESG strategy, as Scott mentioned, it's really important that you know who you are. So you can't be everywhere all the time for everyone. So it's really important that you know who your key stakeholders are, what your material topics are, and what's considered table stakes for your industry and what you want to achieve. So is it just base compliant, or do you have ambitions to be a leader within your sector? So we often work with our clients to talk them through those steps. And from that, you're able to identify what your key performance indicators are, your metrics and your targets that are tied to your material ESG topics. And that is the very beginning of your data needs identification. So what are your metrics and targets based on anchored in your material topics that link to your strategy? And depending on those metrics and targets, that will inform how you will preserve value, create value, or avoid value destruction when you start getting into executing on the strategy. So once you know where you are and where you want to be, start putting in place a plan to get there. And that usually involves an assessment of your data requirements. So what are those material topics? What are your ambitions? And how do they link to risks or opportunities within your organization to drive impact that I shared earlier around value preservation, creation, or value destruction avoidance? And then getting into creating those disclosures and voluntary reports, and then anchoring those in a good controls framework to make sure that your end result, if that is your ambition, for it to be audit quality ready. And all of that ideally would be anchored in a holistic technology foundation where you have automated processes to be able to execute on that control framework. And this isn't easy stuff. We work with many organizations who have dozens of material topics across both the E and the S and G pillar. And within those dozens of material topics, they have sometimes over 200 ESG metrics, whether it's net zero and decarbonization, energy reduction, waste management, water use efficiency, diversity and inclusion, health and safety, talent, board diversity, and tax transparency, metrics and targets all aligned with those material topics. And the data to reporting process can be tricky. So as we sort of double click into that first slide, these are sort of some of the topic areas that I shared earlier. So we work through or help clients through a variety of these key activities. And sometimes we, if there's been a change in their organization, we get them to go back to the beginning. And if they are really good at identifying, they have a strategy, they know what's material, we can start to come in at that risk step and leverage an ESG data architecture and technology that they maybe already have in place. And so I'll share a little bit with you about how we think about the data to reporting lifecycle approach. So usually it's really quite simple of a concept. It's usually like a 4-staged approach. You're collecting and sourcing data from a variety of different origins, Prior to joining the firm, I was at a large integrated energy company, and I can tell you that the way that information is sourced to support ESG disclosure is often from people's heads, their black books, Excel spreadsheets, SharePoint sites, and emails. And more, as companies are facing the changes in regulatory expectations and pressures from investors and customers, the way that sustainability reports were produced and the tools and processes that support them were really developed at a time when there was less reliance on and scrutiny of their ESG information. And so this, lots of organizations are transforming how they're doing ESG reporting, underpinned by audit quality, reliable information right now. It's very, very relevant. And so, like I said, this information can be sourced from a variety of different systems. It's usually transformed, stored, and governed. If you think about the type of information that organizations are gathering, it could contain personal information, it could be sensitive or confidential, and how that's governed, stored, and secured is critically important. And then how it's reported out internally and externally. And then most importantly, how that information is being translated into insight to enable the organization to drive action aligned with their strategy and ambitions. And if we use net zero and decarbonization as an example, many organizations have taken a shoot, aim, ready approach. They've set net zero targets with interim targets by 2030, and they often don't have a plan to get there. 2030 is quickly approaching, and investors and customers, stakeholders alike are all asking, what are you doing to achieve that target? And many organizations have just begun to get a grasp of their baseline. And are beginning to identify levers to decarbonize their business. But if you think that they don't even have a baseline, 2030 is quickly approaching, and they'll be, be challenged with answering some difficult questions in the years to come with respect to these targets that they've set. So let's dive a little bit deeper into the technology space. Got a sticky mouse here. There are many technology solutions and carbon accounting solutions on the market, and they're broken into different archetypes. And we often find that many individuals are thoroughly confused about the different solutions that are in the marketplace. There's ERPs, CSPs, analytics platforms, governance, risk and controls, environment, health, safety, and quality solutions, reporting solutions, and then these really bespoke ones. And the reality is there is no smoking gun. There is no one solution that will help organizations solve their data and reporting challenge in isolation. Some of these solutions don't fit squarely in one category. They see the opportunity in the market too, and they want to expand their market share. And these, their capabilities are expanding into different archetypes, but they are certainly great solutions depending on the problems that you're trying to solve. But like I said, there is no smoking gun. There's no one solution. It really takes a holistic approach across your entire enterprise ecosystem. And so getting into the data conversation, this is a small architecture diagram that covers 3 common ESG metrics: emissions, so greenhouse gas emissions, climate data related to your emissions, your energy usage, and human capital. So you can see across those 4 steps that I described earlier: sourcing, staging and transforming, reporting, and insights. For 3 metrics, it can be really complicated. Data sources come from a variety of different origins: ERP spend, IoT, refrigerant, fuel data. Your human capital information may come from your HR business system. It's layered into your data lake and then transformed to make sure that the units of measure, the emissions factors, it's cleansed and scrubbed so that it's secure and meeting your companies' security requirements. And then it's reported out to a variety of internal and external sources. And this is just for 3 metrics I shared with you, and dozens of real-time data gathering from systems on a regular basis. And then used that for internal and external disclosure, and ideally, and most importantly, to derive insight, to be able to inform decision making, to be able to allocate capital in the most effective way, and enable organizations to execute on their strategies. And so you can kind of see why it would take a cross-functional team. It needs accountants to apply their controls framework. It needs strategy team to identify what the strategy is. Your finance teams take on a whole new role. And so it requires a large collaboration from a variety of different capabilities across the organization. And so what we're seeing in the market is that the same information that's being used for reporting also provides insight into how sustainability obviously affects the risk and performance of the entire business. And assessing this information will essentially unlock value in a variety of different ways. And the reality is, companies with higher sustainability scores outperform their peers. This fact has been proven. Being a sustainable business is just good for business, and it drives profitable growth. And some of the, the benefits that Scott described earlier are like risk avoidance, financial return, reputational uplift, and goodwill, benefiting from avoided cost, increased revenue streams, and minimizing your price burden. And so we're really seeing in the market that ESG reporting regulations are really kickstarting ESG business transformation. And so with that, I don't know if that relates well to the things that you're learning at school around big data and how this ESG use case has compared to or aligns with your areas of interest. But I'm happy to open it up to questions if you have any.
Okay. Thank you very much, both Renee and Scott. That's amazing. While we're waiting for questions, maybe I'll ask a question. And maybe it refers back to something you said, Scott, about the single materiality and the double materiality. And it used to be that we sort of saw those as separate. And, with the single materiality being the ISSB approach and double materiality, as you mentioned, being the European more approach. But you also talk about how even the ones who think about single materiality are looking at broader groups of stakeholders anyway, like their customers. And if the customers care about slavery, modern slavery, or impact of the company on the environment, is the line between the two, I mean, we still talk about them as two separate things, but is the line disappearing, is my question.
That's a really good point, and a really good question, because there is a lot of overlap between the two, I would say. Yes, there's two sides, financial, impact, materiality, but there's a whole bucket of in between. I don't know if you've ever seen those two circles, and there's the in between, that issues that are going to impact both things that you're doing that's going to impact society and the environment, but it's also going to impact financially your business. So like even a simple example there, like a large, massive beverage company, like water consumption and water availability is massively important to their business. So, they could they could be draining draining as much water to help support the production of their product. And you could say, well, if they're draining it from, certain rural communities, that's an impact that they might not be having on, that's an impact that they might be having on society and the communities that they operate in. But is it financially? Well, yes, it could be, because if they're depleting the water too much, that's going to mean that there's going to be a higher cost to obtain that water to support their production. So I think as we see companies go through this, we're seeing a lot more overlap of some of these issues. And Renee was mentioning even like the reputational bit, like piece of it, like there's a social license to do business today. And I would say a lot of our large companies that we're working with, like they see some of this is very reputational, that is critical to their business, critical to their brand. And again, something that has a lot of linkage back to financial results if you kind of, tarnish or be harm or do things that is going to be harmful to your brand and image in the marketplace. So yes, while they are two different concepts, and there might be certain things that are fully in the impact side or fully in the financial side, I think as we see companies go through a lot of these assessments, like there is a lot of overlap between the two. And with the caveat, it really depends on the company and the sector that they operate in and where they operate as well too. So there's a lot of those factors that drive as well.
And I think the customers are increasingly, they're more vocal. They have more of a say, through social media, whatever. So I think the customers, at the risk of sounding cynical, they either care about the environment because they care, or they have to care because their customers care, right? I think we're moving to that point where they have to care one way or another.
Yeah. And companies are trying to get ahead of that. So I had a conversation with a large home builder in North America, and the CEO's comment was, well, and they're retail, like they're consumers, so right, B2C, like selling homes, right? And the comment that was made there is, well, while we're focusing on ESG and energy efficient homes and net zero homes, not because maybe we necessarily think the customers are going to pay a massive premium for it today, but we think that's not going to be the case 5-10 years from now. So like there's that element to it as well too, I would highlight. And then on the consumer and customer side of things is like the institutional ones, they certainly bark a lot louder than maybe the retail ones at this point in time. So we're seeing that really come into play. Like another example being the automotive industry. There's many different car manufacturers that are looking through their supply chain of where they source steel from or these parts from, and again looking at is there modern slavery associated with that? Is there what's the carbon footprint versus this steel versus that steel and cost? So again, that's another example of how customers and clients of various businesses are starting to drive the action on some of this.
I don't see any questions yet, so I have another one. I'm going to steal that. But you talked, I think, Renee, about trust and transparency being really important principles there. And on one of the slides, the earlier slide 11, you said 81% of the companies that you surveyed don't financially quantify climate-related risk. So I think that was on slide 11.
That might have been on
yeah, it might have been. But I'm thinking about the trust and transparency. So when it's not quantified, and we've got people who should be able to quantify it, given all Renee, you talk about the increasing amounts of big data, and we now have the technologies, and we've got people who are focused on, making quality assessments based on the right data. So yeah, I'm going to be provocative there, but do you have any thoughts on why they're not quantifying? I think we're beyond the point where we say we can't measure. In a lot of the standards, even in IFRS, we talk about there's a rebuttable presumption that you can measure things. And so them not measuring to me is signaling something. I don't know what, in that inaction of not measuring, I think is a message somehow. Or are they afraid to show? Are they afraid to measure? Because then it might show something they don't want shown. The greenwashing piece that you talked about, Renee.
Yeah, Scott. So that's on slide 11, and I'm just looking at it, and it does say 81% of organizations surveyed don't financially quantify their climate-related risks. And so, correct me if I'm wrong, Scott, but I think that translates. So they probably do measure their emissions within their value chain, but they may not be translating that into financial-related risks. Scott, I don't know if you want to elaborate on that.
So that's like where we are right now in the marketplace, and there's leaders out there that are doing it. And again, probably to my point is people are starting to get more sophisticated. I can say for certain that there's companies in the background doing it. They just haven't got to the stage where they're publicly disclosing it yet.
That's right.
So we are still in a very much so voluntary reporting space because regulation hasn't fully kicked in. That is going to change when regulation starts to kick in. We're going to see companies start to piece that together a little bit more. And the other part too, like it is tough. Like it's not as simple. Like it's thinking forward of like, well, how are these climate risks impacting my business? Not next year or the year after. It's 10 years, 20 years down the road. So there's a lot of challenge, I would say, with some of that, and that's probably been part of the delay. But I think what we've what we know and some our conversations that we're having in the marketplace, there's a lot of organizations that are working on this, and again, want to get to that area where they're comfortable in reporting certain numbers, again, to reduce that risk of greenwashing, making sure they're comfortable with the critical assumptions that go into it before it's actually being reported. So while that might come as off as a surprise, it doesn't come off massively as a surprise to me, just knowing the lack of maturity of where we are.
Yeah,
Oftentimes, Irene, we encourage our clients to take a phased approach. And so usually when we're doing these types, supporting clients on this journey, we encourage them to take a qualitative approach first.
Mhm.
And so then you can begin to rank over low, medium, and high, for example, where climate-related risks over physical or transition or acute or chronic risks exist within their asset mix in different geographies. And so once you have that, then you can start to dive deeper into your areas of greatest risk and start to more quantify it essentially. But it's not an easy
Yeah.
task. We have a dedicated team who do it, and they're some of the most brilliant scientists in our team.
Yeah, absolutely. So it's baby steps in some kind of path. Get
Phased
people
approach.
walking down that path, right? Okay, we got a question from Samir. Can you see the question?
Yep. So how our firms are picking and choosing among the various reporting frameworks? Don't you think that the availability of various frameworks create an incentive for greenwashing? And absolutely, in this voluntary space, there's flexibility in terms of what framework, but there's also flexibility in terms of what you want to report under that framework. So some portions of it, but not other portions. So does that absolutely create the opportunity? And going back to my saying before, telling the good story and not the full story, I would say. And that's, I would say, reflective of the marketplace as a whole. There's some organizations that do a really good job to say, hey, we've gone through the whole SASB or the GRI and we've hit off every piece. So yes, and I think if I go back to even our investor survey, that links back to that stat about, even investors think that there's probably stuff that's unmerited or, there is some greenwashing that is going into some of these reports to date. Now, to solve that's where the regulators play a critical role in driving things like you're required to align with ISSB, or if not necessarily ISSB, what are those guardrails that companies should be reporting on? Because what that's going to drive is create better consistency and comparability, but also completeness of reporting. So yes, in today's environment, it probably is amplified a little bit as a result of that, but I would say, over time, I think that's going to rapidly go away as we see more convergence and alignment towards the consistency and regulation coming into play.
If I may add, Scott, like from a public practice perspective, when we say this is greenwashing, this is not really genuine ESG reporting, like based on your experience and Ronnie experience, at what some point of time you guys say, I don't buy this. This is really cheap talk.
That's a subjective thing as well, too, right? So in terms of greenwashing, it can be a subjective piece. Maybe I can talk from an assurance perspective.
Standpoint.
I lead a team of a number of folks that provide ESG assurance as well, and on top of ESG reporting advisory work that we do. And the assurance plays a key role in building trust and building credibility in what companies report. So you go back to even what I was on, there's a huge demand for more sustainability information that is being reported, but there's a huge demand for more reliable sustainability information that's being reported. And that's where assurance really comes into play, I would say. And just to share, like, how do we assure as an organization? So we have a subject matter. That subject matter could be your scope 1 greenhouse gas emissions, or that subject matter could be the number of health and safety or incidents or accidents that you had as an organization. And you can compare that. If I look to financial reporting, compare that your subject matter is your financial statements under IFRS, and you assure that against a criteria, which is under IFRS is the criteria. In the ESG space, we assure for greenhouse gas emissions against the protocol, the greenhouse gas protocol. So that's our criteria. Or for health and safety in terms of the management's a methodology that they've externally disclosed. So one of the critical things that we do is we check to say, is this leading practice? Are you following the leading criteria, being in the case of the protocol. And where we think, well, you're leaving out emissions, for example, or you're not using the right emission factors because this is more favorable for you. Absolutely, those things are flagged as part of that assurance process. So I think that's another key trend that we're seeing in the marketplace is more focus and push for assurance with this sustainability information, again, to build up that trust and credibility in terms of what's being reported.
Thank you.
And then we have Jessica has got a question there. Jessica's.
Jessica, thank you for that. How do you think companies should work on assessing nature-related risk and opportunities? How should they integrate biodiversity into their strategic plan? I don't know, Renee, if you want to take that one, or I'm happy.
Yeah, happy to take it. So nature and biodiversity are no different than any other ESG topic. And so they should be assessed for relevance to your business, and they should be assessed for materiality. And so more and more, we're seeing the TNFD, which is the Task Force on Nature-Based Reporting, is very similar to the TCFD, which is applying very similar concepts. But nature is no different than any other ESG factor, and so it should be assessed for materiality to your business and reported on accordingly.
And
So I hope that answered your question, Jess.
And maybe just a general comment too is like climate is the one that a lot of organizations are focusing on, or some of the social, like the biodiversity impacts as well as nature. There's some, and one of our partners, Dan O'Brien, which maybe some of you also heard during the presentation, he sits on the TNFD, which is kind of setting that framework up for disclosing around this. The overarching comment I'll make it is still early days around companies actually assessing that, and it can be amplified for certain industries or companies than others, depending on the nature of your business. But again, it's a pretty challenging thing when you're looking through your whole supply chain in terms of what's the impact that you're having on biodiversity or nature as a whole. But I think we're really going to see a lot of companies start thinking about that. And one, just plug on the ISSB in particular, they've already highlighted, they've come out with a climate standard and that general standard, but they've highlighted on the priorities for the next coming years is to focus also on a nature and biodiversity standard as well too, and they'll likely look to the TNFD. So there's probably a lot more to come around companies assessing those risks and opportunities and reporting on it as well.
Okay, great. And Renee, I think another question for you there with your pipeline.
So the question is, Renee, in the pipeline you showed, where do you think are the main pain points, manual work for using human capital that can be solved to create comparable and consistent metrics? And then NLP and ML, what is that? What are those acronyms? Am I missing that?
Machine learning, natural language.
Natural language processing.
Yeah.
So I think the main, there's a few things. So it's ambition. So firstly, like organizations are not required to do this right now. And so as Scott mentioned in the beginning of his presentation, the status quo, it has not been challenged. So using spreadsheets and emails and the absence of expectations to apply a controls framework is essentially the status quo. And so more and more as new expectations are going to be imposed on this reporting, it's going to be expected to be reported in a timely, reliable, consistent, comparable way. And that's where I think the machine learning, the natural language processing, the automation are really, really going to be able to come into play. And there's an aspect around the timeliness of it. Lots of this information is only collected on an annual basis. And so to be able to accelerate the data collection to reporting timelines, they'll need to have more modern ways of working. And that will force organizations to think about the capabilities they have within their teams who can deliver on that. And that goes back to the question around, are data engineers and other new capabilities going to be needed? Absolutely. And so right now, I think the constraint constraint is ambition, unfortunately. Until a rule comes in, forcing organizations to do this on a more real-time basis, we're really seeing the adoption of these more modern ways of working being done by leaders, innovators within the market. Otherwise, lots of organizations are waiting until there's a compliance driver for that.
So the market is ripe for disruption by these more nimble.
Yes.
I
We don't
100%.
have those sunk costs and those old ways of thinking. So I like that. That's very cool.
Totally agree.
Yeah, any other questions? And you know, you mentioned Dan. Yes, we had Dan speak at our conference on sustainability, Morrison.
Right.
So yeah, great to hear about his work on the task force on nature-related disclosures. Yeah, it's great. Any last questions? Because I think, yeah, we're getting to the end of our time. We usually we have an hour and a half set aside, but usually we understand people have got things going on. So any last questions? Here's your chance. Okay, with that, I am just going to say a huge thank you to both Renee and Scott. Always a pleasure to have you, Scott, we've had you speak several times, and always a pleasure to have you back. Renee, love to hear more of your perspective. I think it's great. So thanks again, and thanks to you all for joining us. So our next session is on November 29th, where we will be examining AI in climate action with Professor David Rolnick from McGill University. So thanks, everyone. Have a great day.